Hi people. Today we're going to be talking about how to build a very simple leveraged buyout or LBO model. I think when you're starting out with financial modeling, people generally freak out about the LBO. There seems to be the impression that there's this crazy layer of additional complexity, but the reality is that it's very simple. And all you're really doing is making some changes to the integrated financial statement model you already built. And if you've not yet gone through the process of building an integrated financial statement model, I would suggest visiting this series here. If you scroll through the model, and to do that, let's zoom out a little bit, you will see that the core of the leverage buyout model is just the integrated financial statement model, in that we've added sources and uses above, a section for your balance sheet adjustments to the right of the balance sheet, and a section titled Exit Analysis at the bottom. Otherwise, the LBO model is just the supporting schedules you've built previously, and the three principal financial statements. So what's the purpose of these new sections? In a leverage buyout model, an acquirer, and let's say that's you, is buying a business with a combination of debt and equity. To record this transaction, we must first determine the price you're going to pay to buy the business, and then the expenses it will take to close the transaction. In most transactions, there will be fees associated with the due diligence process, such as those paid to investment bankers, and fees related to financing the purchase. The sum of the purchase price and the transaction expenses is the capital required to close the transaction. When you've calculated this total, you must then determine the sources of capital you will use. And in an LBO model, this will be some combination of debt and equity. And then you have your uses, which show how this sum will be allocated. And here we have seller proceeds, holdco debt, transaction expenses, and financing fees. And you'll note that sources are always equal to uses. The next step is to record this transaction on your balance sheet. And to do that, we will have to make a series of balance sheet adjustments on the right-hand side of our balance sheet. Finally, the last step is to record the performance of your investment on the exit analysis below, which in this example will be a very simple and straightforward process. And that's really all there is to it. Before we get started, I just wanted to quickly point out a few things. In this video, I'll be skipping over the process required to integrate the three financial statements. The structure of that portion of the model is nearly identical to the model you've already built. I'd also like to point out that I've added some color coding. Items that link to the supporting schedules are shaded to reflect the supporting schedule they link to. As an example, here you'll see the debt schedule. And above that, on the cash flow statement, you'll see that all debt items are shaded a lighter purple. And finally, the balance sheet adjustments are also color coded. As we make these adjustments, I believe it'll make it easier to understand how the sources and uses affect the balance sheet. Now, there is one big change to the process of inputting historical data and then projecting these figures. On the balance sheet, you'll notice that the input columns are no longer right next to each other. This is because we are recording the transaction to the right of the balance sheet, and then using our new post-transaction balance sheet to project the financial statements. So let's quickly walk through that process. Recall that your balance sheet shows the financial position of a company at a given moment. So after the balance sheet adjustments, the post-closing balance sheet you'll see here represents the same company post-transaction. Once you've input the data for your two historical periods, the next step will be to populate the post-closing side. To capture all of the adjustments made, we will use the sum formula for all items on the balance sheet. The only exception should be for totals. With that done, the next step is to link the post-closing balance sheet to your financial statement model. And here again, we'll do that for all items on the balance sheet, the only exception being for totals. With the balance sheet linked to the adjustments, the next step is to project the balance sheet the same way we did in the integrated financial statement model. And with that exception, the process of integrating financial statements for an LBO model is nearly identical to the process used for the integrated financial statement model. So let's get started with tab 1 of the downloadable worksheet and start building out the sources and uses section. It's quite common to refer to the value of a business as a multiple of its EBITDA. So as a first step, we'll reference the EBITDA of the business on the last historical income statement. And let's say that a purchase price of roughly 6.5 times EBITDA, or for the sake of round numbers, $100 million, has been agreed to in this transaction. Below you have enterprise value, or your purchase price, as a multiple of EBITDA. Next you have your debt multiples, and let's say that in this transaction you can get 2.5 times EBITDA of subordinated debt and 1.5 times EBITDA of senior debt. These multiples will make a little bit more sense momentarily. Finally, you have transaction expenses, and let's say for the sake of simplicity that your transaction expenses are $1 million and your financing fees are also $1 million. The difference between these two categories is that transaction expenses refers to a fee paid to an investment banker or legal counsel, or perhaps additional accounting work done in due diligence. And the financing fee relates to what a bank charges you to raise capital, and in the case of this model, senior and subordinated debt. So with these values determined, we know that the total required is the sum of the purchase price, or enterprise value, and your transaction expenses. So now we know that the transaction will require $102 million, and that you can get 2.5 times EBITDA of subordinated debt and 1.5 times EBITDA of senior debt. This would imply that the remainder must come in the form of equity. And to calculate that, we'll take our total and subtract the sums raised as debt. With your sources calculated, you can move on to uses, and recall that sources and uses are always equal. We can then link to the inputs for transaction expenses and financing fees. To pay off all debt on the balance sheet, link to historical debt balances on Oldco balance sheet. And here that is cells L78 to L80. Everything that remains goes to the seller. To calculate that, take the total and subtract the balances below. And with that, we're done with the sources and uses, and we can move on to the balance sheet adjustments. For the balance sheet adjustments, we'll be moving on to tab 2. For a better view, we can collapse the ribbon above and zoom out just a little. So let's spend a moment talking about the adjustments we're going to be making. So that we can have the left-hand column and adjustments in the same view, select the tab titled View, go to Freeze Panes, and freeze first column. In this way, as you scroll over, the first column will remain fixed. Here you'll see that the balance sheet adjustments have been color-coded to match the sources and uses table above. What we're really doing here is in the first two columns, adjusting the balance sheet to reflect a new capital structure. And then in the middle two columns, deleting the old capital structure. The last two columns are used to reflect the transaction fees and the financing fees. So let's get started with the first column. To record the new equity coming into the business, under common stock, we will link to the source schedule above. And to reflect that this is a cash inflow, we will include this as a positive balance under cash. If you recall that the equity account represents ownership interest, you can also think as this adjustment as reflecting the new ownership of the business. In the next column, we will adjust the balance sheet for our new sources of financing. So first, link to subordinated debt. And then, of course, senior debt. And again, because this is a cash inflow, we will reflect it as a positive balance above. Switching over to uses, the first step is to wipe out the old ownership interests, which is easily done by linking to the historical data and making it negative. This next step will require a lot of additional explanation, and we'll have a fair amount devoted to it in the notes. The value of the purchase price in excess of your net identifiable assets is known as goodwill. And here, when I say purchase price, I want to make clear that I'm referring to the seller proceeds, or the value of Oldco equity. So to make this adjustment, we will first link to seller proceeds, and then subtract the value of your net identifiable assets. And if you think of net identifiable assets as assets less liabilities, then this is equivalent to the balance of your equity account. This adjustment touches on quite a few concepts, and I'll be adding additional material to explain the calculation in greater detail. To reflect that this is a use of cash, we will show these sums as a negative balance above. Fortunately, paying off old co debt is far simpler. For this adjustment, we will simply make the historical balance negative, and then of course record it as a use above. Transaction fees are expensed, and to accurately reflect that, we will reduce retained earnings by this balance. And record the use above. Financing fees, however, are capitalized. To properly reflect this adjustment, we'll add it to our balance sheet as an asset that will be amortized over the life of the loans made. And of course, because it's a use, record it as a negative balance. What you'll notice is that the sum of your uses is equivalent to the sum of your sources. And because your sources reflect positive balances and your uses reflect negative balances, the effect on cash is zero. So when you look at your post-closing balance sheet, in this example, the cash balance is the same as your pre-closing balance sheet. And all of the adjustments are captured by the sum formula. And anytime you make balance sheet adjustments, you should always check to make sure that your balance sheet is still balanced. And so long as your check is equal to zero, you're good to go. And just as a quick recap, and starting with column 1, what we've done here is record new ownership, and then in the second column, our new sources of financing. In the third column, eliminated the old co-equity interests and recorded goodwill, which is the purchase price of old co-equity in excess of your net identifiable assets. And then in the fourth column, paid off old co-debt, and in the fifth column, expensed the transaction fees. And finally, in the last column, recorded the capitalized financing fee asset. And with that, you've completed the balance sheet adjustments, and we can move on to the next step. With that done, we can move on to the third tab to build out the exit analysis section of the model, which is the last step and can be found at the bottom of your model. The purpose of this section is to measure the performance of your investment. To do that, you must first project what you believe the value of your equity will be in the exit year. Let's say that you believe you will exit in the last projected period, and that when you exit, your business will be valued by the marketplace at 7 times EBITDA. You will then link to EBITDA in the last projected period on your income statement, and then multiply the EBITDA multiple by EBITDA in the exit year. The product of your EBITDA multiple and EBITDA gives you enterprise value at exit. To arrive at equity value, you must then subtract your debt, and this will pull from your balance sheet. And then add cash. So finally, your equity value is your enterprise value less debt plus cash. With the equity value calculated, the next step is to determine your ownership structure. Here we're going to say that the subordinated debt provider gets an 8% ownership position, which would imply that the equity is left with the remaining 92%. So finally, the last step is to determine your return. And we will be doing this for both the equity and subordinated debt. For the equity, your interest rate is not available. Your ownership position is the 92%. To calculate the IRR achieved on this ownership position, we have to enter dates to provide a time horizon. And to make sure that this video is relevant for a very long time, let's say that this investment is made December 31st of 2022. We can then use the date formula for all the other periods. And because each period represents 1 year, add 1 to year, and then for all others, just reference the previous cell. And we can then project this formula across. And since it's a formula, we'll remove the yellow background and blue text. So on the day the investment's made, we will show the equity as a negative value. And then calculate the equity value in your exit period by multiplying your ownership position by the equity value. And we will then reflect that balance on the investment line. Finally, we can calculate the return, starting with the IRR. And to do that, we will use a formula XIRR, which, as you can see, returns the internal rate of return for a schedule of cash flows. And to use this formula, we will first select the corresponding values, and then the corresponding dates. To calculate your cash multiple, take the value of your proceeds at exit and divide by the positive balance of your investment. We will take nearly the same approach for your subordinated debt return profile, but there are a couple of additional variables. So first, link to your interest rate above on the debt schedule. Then link to the corresponding ownership position. We can use the same dates as above. Then link to the balance in your sources and uses table. And recall that this needs to be a negative number. Finally, we need to reflect all cash flows received by the subordinated debt. So first, interest paid on the debt schedule. And paste that across for all periods in which interest is paid. And then calculate your equity value. And with debt, in addition to equity value, you have return of principal. And for that balance, we can link to the debt schedule above. Then be sure to include all of these cash flows in the investment line by using the sum formula. We can paste across. And then we will use the same formula to calculate our IRR equals XIRR. And first select corresponding values, and then corresponding dates. And for the cash multiple, take the sum of all cash flows and divide by the positive value of your investment. And with that, you can see that on your equity investment, your internal rate of return was approximately 31%, and you achieved a cash multiple of 3.8 times. And that your subordinated debt provider achieved an internal rate of return of approximately 17%, and a cash multiple of 2 times his original investment. And with that, we're done with the exit analysis. Before moving forward with some concluding remarks, I wanted to point out one more thing about the integrated financial statement model that the video starts with. This model is very similar to the model we have built previously, with the exception of one additional supporting schedule. The amortization schedule you see here, just below the PP&E schedule. I wanted to wait to point this out because I think it makes more sense with the numbers flowing through the schedule. You may recall that in the balance sheet adjustments, the last use was the financing fee, and that unlike transaction expenses, the financing fee appears as an asset on the balance sheet. This is because financing fees are amortized over the life of the loan. To illustrate this, the amortization period is linked to the debt schedule above. Here you'll see that cell D156 is the amortization period for senior debt above. In reality, if the financing fee related to both the subordinated debt and senior debt, you would have to consider the subordinated debt in this amortization schedule as well. but to keep it simple, we just link to cell D156. And this schedule is really quite simple to build. It starts by linking to the balance sheet to pull the capitalized financing fee asset, and then reducing this value by 1/5 to arrive at a balance of 0 in the final period. With this exception, the integrated financial statement model that this video starts with is really identical to the previous model built in integrating financial statements. As a quick recap, if you were to start from the beginning, the sequence for building your LBO model would be to first input historical data, then project the financial statements, starting with the income statement, then the balance sheet, and finally the cash flow statement. Then move on to your supporting schedules, starting with the debt schedule, then the PP&E schedule, and finally the amortization schedule we just discussed, which would get you to the fully integrated financial statement model, which is the starting point of this video. From there, you would build out your sources and uses, make the adjustments to your balance sheet to record the transaction, and finally build out the exit analysis section of the model. The information provided under exit analysis is really what determines whether or not this LBO is a favorable transaction. The purpose is to determine whether or not it is attractive for all participants. Your subordinated debt provider might believe that an IRR of 17% is too low. To boost the return, he may require a greater interest rate, or larger equity position of, say, 10%. As we change this input, you'll see how the IRR and the cash multiple change. As an equity investor, you may decide that this is still attractive, being at an IRR of 30%, and be willing to provide the additional equity to your subordinated debt provider. There are plenty of additional features we could add to an LBO model, including scenario analysis, data tables, debt ratios, financial statement analysis, etc. All of this will be explored in future videos, but for the time being, this is a quick template to better understand the LBO building process. I'm hoping that by introducing the LBO in a simple format, the additional layers of complexity will be easy to understand. But for the time being, you're done with the LBO model. Okay then, bye-bye now.